Section 121 lets you exclude gain when you sell your main home. The cap is up to $250,000 for most single filers and up to $500,000 for certain joint filers. On the EA exam, they'll test the difference between exclude the gain and ignore the sale. If you can exclude all the gain, you generally don't have to report the sale. If any gain is taxable, you do. Only a main home qualifies. Not your rental, not your vacation place, not your second home. Your main home is where you live most of the year, and it doesn't have to be a traditional house. It can be a condo, co-op, mobile home, even a houseboat. The key is that it functions like a home: sleeping, kitchen, and bathroom facilities. To be eligible, you need 3 big checkpoints. 1, you sold your main home. 2, you meet the ownership and use tests. 3, you didn't use the Section 121 exclusion in the 2 years before the sale. That last one is a classic exam trap. There are exceptions for job change, health, or unforeseen circumstances, but those are tested separately. Now the heart of it, the 2 out of 5 tests. During the 5-year period ending on the sale date, you must own the home at least 2 years and use it as your main home at least 2 years. The IRS counts ownership and use separately, and the 2 years don't have to be continuous. On the EA exam, watch for facts like moving out and back in. Those months can still add up. Here's another subtle point they love. The ownership period and the use period can be different 2-year windows, as long as both happen within the same 5-year lookback. Practically, think 24 full months or 730 days for each test. So if you owned it for years but only lived there for 2 years total, you can still qualify. But if it's never your main home, Section 121 is off the table. Finally, reporting. If the entire gain is excluded, you generally don't report the sale. But if any gain is taxable, you must report the sale as a capital transaction, typically on Form 8949 and Schedule D. And if it's not your main home, the gain is taxable and gets reported. For exam questions, always ask, is there any taxable piece? If yes, reporting is required. Marisol bought her home 3 years ago. She fell behind on payments, and the bank foreclosed on January 10, 2023. The debt was used to buy the home, and it was her primary residence. She received Form 1099-C for canceled mortgage debt. She was not insolvent and not in bankruptcy. How should this be reported? Schedule B, Form 8949, and Schedule D plus Form 982, canceled debt on Schedule D, or canceled debt as other income. Think about it. The best answer is Form 8949 and Schedule D for the foreclosure disposition, and Form 982 to exclude the canceled qualified principal residence debt. Foreclosure is treated like a sale or exchange, so you report the property disposition to account for basis and gain or loss. The tempting wrong choice is reporting the 1099-C as other income on the 1040, but Form 982 is how you claim the exclusion when it applies. Ethan is unmarried. He sold his home for $275,000. Selling expenses were $10,000. He bought it 7 years ago for $125,000 and lived in it as his main home. He qualifies for Section 121. How much gain can he exclude? $250,000, $140,000, $150,000, or $125,000? Think about it. The answer is $140,000. First, compute the amount realized. $275,000 minus $10,000 selling expenses equals $265,000. Then subtract basis of $125,000, giving a $140,000 gain. Because he qualifies for Section 121 and his gain is below the $250,000 limit for an unmarried taxpayer, he can exclude the full $140,000. The tempting wrong answer is $250,000, but that's the cap, not the gain.